David George is Senior Research Analyst at Baird, very importantly, with decades of experience. David, what are you writing this morning? Let me just cut to the chase. What matters right now for David George?
We wrote this morning, Tom, good morning. Thanks for having me. We believe that this is an asymmetrically positive risk reward for regional bank stocks. In fact, probably the most constructive that we've been since COVID, maybe even more constructive than that. This is one of the best setups that we have seen in the last 23 years. And this is an unbelievably good risk reward setup for the stock.
What is the skill set to determine that a given bank is not seeing outflows and that given bank has trust and confidence? Part of it is obviously it's difficult to predict customer behavior, but I think something that has gone undiscussed in the financial media is, and I don't cover Silicon Valley, but I think it's important to note that they have $220 billion in deposits. Do you know how many branches they had? 18. Do you know how many branches U.S. Bank has? 5,000. The average deposits per branch at most U.S. banks is about 15 to 50 million, not 2 billion per office. So the granularity of most U.S. regional banks' funding is just infinitely different than the kind of banks that have been reported that have failed. So obviously we are in a period where investors have long memories and there's panic, but that is where you get these asymmetric opportunities, and that's where we are, in my opinion.
That said, David, there's a very different scenario that is uniform pretty much across all the banking sector as well as beyond, which is the immediacy of being able to withdraw in real time, online, at any time, the ability for there to be a bank run that happens so quickly that even regulators are caught completely off guard. How does that change your risk assessment of smaller banks, especially at a time where cash is paying something and a lot of people are concerned that these banks are not going to be able to deliver?
Well, first of all, I am not concerned. Maybe that doesn't matter. But to your second point, Lisa, the movement of funds into treasuries and higher yielding alternatives, that's been going on for over a year. So that is not a new phenomenon. Now, how people feel about that, given where the stocks have been trading, is new. But fundamentally, that has been happening for several months and several quarters. In terms of the movement of deposits and things like social media and media like yourselves talking about bank runs, that's really not that helpful, to be honest, to depositors, because most customers of regional banks do not have millions of dollars. They've got maybe $5,000 in a checking account. Maybe a small business has got $100,000. They are not focused on this. They are focused on running their businesses. So I just think that the similarities between Silicon Valley and most other what I would call Main Street banks couldn't be more different.
That said, there is this concern about the interest rate risk at a lot of banks. And I am wondering from your perspective, putting aside, what the media's role is or what investors' role is or what the reputational risk is, what about the nuts and bolts, potential unrealized losses on the balance sheets of a number of regional banks that haven't necessarily hedged against a dramatic rise in interest rates and among all of their assets they use to back those customer deposits?
Well, a couple things. So banks, as part of the Dodd-Frank legislation, have to own securities as part of what's called the LCR, liquidity coverage ratios. And keep in mind, Silicon Valley and banks under $250 billion in assets are no longer subject to that legislation. All of the big banks that we talk about are all subject to that, by the way. That's another thing that has gone unreported and unnoticed and undiscussed. In terms of the interest rate risk, yes, there are banks that are sitting on securities. These are money good securities, by the way. These are treasuries and MBS that pay as agreed. These are not subprime loans. These are not CDOs. These are money good securities. And by the way, deposits have value as well. They are not marked to market either. So despite that, you have banks that are generating, JP Morgan, what did they make last quarter? $8 billion of earnings. B of A made $5 billion of earnings. This is just not a crisis. 2008 was a crisis. This is a very short-term crisis of confidence driven by one bank that was essentially a levered PE fund. So from my perspective, there are obviously unrealized losses. And by the way, with bonds rallying,
those losses are now becoming gains, and that will change over time. Most banks will hold these securities until maturity. But I think just to say that these banks aren't managing interest rate risk, I think is not an intellectually honest statement from my perspective.
Well, David, it's always fantastic to get your perspective. Repeatedly through this conversation, you do sound somewhat frustrated with the way this story has been covered over the last 3 days. What would you like to hear more of going forward? What are the questions that you think have been missing?
I just think that the constant focus on is your money safe, it just, and I think the proliferation of social media is obviously something that I know you're not necessarily engaged in, but I think it's just important to, I think it's important to just distinguish between banks and their funding and their customer bases. And, this particular situation is frustrating when you've got not to get political, but when you've got a VC legend tells everyone that screams fire in a crowded theater. That's not helpful either. And that's a whole nother discussion. But I think the main thing is just having some differentiation between banks. And by the way, there will be beneficiaries of this. All of the large banks, as you kind of referenced a little bit earlier before we started the show, they will benefit from this. So there will be your big 10 to 15 banks will be net beneficiaries, which is something that, again, I think has not been discussed. And those stocks have gotten smoked as well.
It's something we've talked about a lot over the last 3 days. A lot of money is going to go to the SIBs. There's going to be a premium attached to them just in terms of safety, perceived safety. David, this was great. Let's try and make this regular because I have no doubt there's going to be a story for the next couple of weeks, maybe even next couple of months. David George there of Baird.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern.